bank reconciliation statement. And in this module, we will learn those possible reasons of differences for which we prepare bank reconciliation statement. Look, we have already discussed that there are two reasons of difference. One is because of adjusting items, and the second one is because of reconciling items. Adjusting items are those for which we need to amend our cash book. And as we have already discussed, that these are certain reasons for which we were not informed by the banker, which include credit transfer, direct debit, standing order payment, etc., or bank charges or interest on overdraft. And these adjusting items also include certain mistakes by the accountant. Accountant could not correctly enter the information or transaction in the cash book. So for that reason, we have to adjust our cash book. Once we are done with this adjustment thing, then we prepare bank reconciliation statement. Always remember that bank reconciliation statement is prepared for the reasons in which the business accountant cannot do anything, or for the reasons to which the business accountant does not have any access. These are something for which the accountant of the bank will do either adjustment, or there would be some timing difference that these reasons will automatically be eliminated depending upon some time period. Within that time period, it will be eliminated. So let's see. These are the reconciliation items for which we present a bank reconciliation statement. So number 1A, these are not yet recorded in the bank statement, which include check from a customer. You as a business accountant received a check from a customer. You correctly record that check in your cash book, and also you have deposited in the bank. But the issue is that it is not yet collected by the bank. So when you recorded that in your cash book, you recorded as debit in your cash book, because this is the check received from customer, which will cause an increase in your bank balance. So this is something to be credited in the bank reconciliation statement, assuming that you have made excess debit in your cash book. For this, you will not amend your cash book, rather you will just present this as a working in a separate sheet, which is known as bank reconciliation statement. Well, the second one is the check that you have paid to supplier or someone, and you have already recorded that in your cash book, but that has not yet been presented to the bank. The person to whom you paid that check did not present that check in the bank, against which the bank did not make any payment. So since you have paid this check, means you have recorded a reduction in your bank balance, and whenever you record reduction in your bank balance, you record it as credit. So you are assuming that that credit is wrong or excess. That's why you will give debit effect to this check which has not yet been presented in the bank for payment. Then comes some mistakes committed in the bank statement. Always remember, if you can do mistake, the bank accountant can also do some mistake while developing the records for you in its own books of accounts. That can be straight away wrongly debited or charged by the bank, means you did not do this mistake, or wrongly credited by the bank in your account, obviously. If it is wrongly debited, the credit effect will make it correct. And if it is wrongly credited, debit effect will make it correct. So I repeat that there are two basically the types of reasons for which we prepare bank reconciliation statement. Number one, the checks, in fact you can say that these are the reasons which are being created because of timing difference. Means you have deposited this check, but its amount is not appearing in the balance bank statement. And the second one is you have made payment to the supplier, you have paid a check, but its payment is not appearing in the bank statement. So these are the effects to it, and if there is some mistake, so you will make it correct. So the important tips to remember in this module include, which are really important to remember, that the check that we receive from our customer and deposit it into the bank, and that is still not appearing in our bank statement as a deposit, has few more names. Means being a student, you have to, end of the day, you have to solve your examination question. So in your examination question, you will find few more names associated to this concept. And those are uncleared checks, uncredited checks, uncleared lodgements, deposits in transit, and outstanding lodgements. All these are the names for those checks that you have deposited into the bank. Bank has not given credit in your bank statement. Always remember, when bank gives credit, it means your bank balance has increased. And when bank debits your account, it means your bank balance has decreased. Because when you are having a deposit in the bank, it is an asset for you, but it is a liability for the bank. Remember, when you have deposit in your bank, it is an asset for you. Just see that you have a balance in the bank. It's an asset. But the bank is under obligation to pay you back. So it's a liability for the bank. For a liability, when you have to increase liability, you give credit. That's why for your asset, when you are depositing in the bank will give you credit. Liability will increase. The bank's liability will increase, means that your asset is increasing. At the same time, when you withdraw cash or through a check from your bank, the liability of the bank decreases because the bank has made payment against the deposited amount. That deposited amount was liability for the bank. That has been reduced by making such payment. So whenever there is a decrease in liability, it will be debited. So here I want to make this thing very much clear to you, which is a misunderstanding or a confusion that bank does opposite accounting. No. Bank does not do opposite accounting. The accounting principles for the bank as an entity and for a business as an entity are 100% same. But the issue is that the deposit that you are keeping with the bank is asset for you and liability for the bank. That's why increase in that liability is being reflected through credit and decrease is being reflected through debit, because that's a liability for the bank. Well, the second thing that you have to remember as a tip, the different names for unpresented checks, which are outstanding checks, uncashed checks, and unpaid checks. I believe this terminology will help you to solve question correctly. Thank you.